Hello, this chapter we're going to talk about how to value stocks. So we will go over stocks features and stock quotes, and we will talk about different kind of models for stock valuations. So it's very useful if we know what is the fundamental value for the stock. Then when we observe stock price go up or down, we have a better understanding if they are undervalued or overvalued. First of all, let's go over the features of stocks. There are two types, common stock and preferred stock. Common stock, you can vote. You can vote who want to be the board of directors. So that's voting rights. There's special votes for proxy votes where it's useful in the proxy fightings. Different classes of stock allow insiders to have more control of the ownership. Some companies don't pay dividend. The most companies pay dividend at a quarterly basis. In special cases such as bankruptcy, company will liquidate everything and pay a liquidating dividend. Dividend is not a liability, so companies okay to skip dividend or cut down dividend, so you cannot sue the company or go bankruptcy if companies skip or not paying dividend. For investors who receive dividend, there is tax consequence. Preferred stockholders, they don't vote, but they have priority in receiving cash flows, cash dividends. Most time, company try to honor and keep paying quarterly dividend for preferred stockholders. So in this chapter, in this lecture, our focus is try to find out what is the fundamental stock value. So we not try to predict the stock price movement. The motivation to figure out the stock value model depends on the cash flows with the stock investment. So you may buy stock today and hold it and sell it later. Then it is exchanged among investors. So for all the investors, the actual cash flow is going to be the cash dividend. You may wonder, some companies don't pay dividend right now. However, when the company become mature, in the future they will pay dividend. So if you look at investor as a whole, the cash flow associated with the stock investment are basically cash dividend payment. So to find out the stock value is a process looking for the present value of all the future dividend. But this model looks a bit complicated to implement. As you see, there are infinity number of the infinity number of stock dividend. Graham, Harvey, and Mackley, they did a survey for the top 500 Fortune companies. The CEOs of those managerial report, they want to keep a steady, smooth dividend policy. They don't want to really change much. So this helps us a lot, try to simplify dividend into different cases. Case number one, company pay the same amount of dividend. They don't increase or change. So there's no or zero growth in the dividend. Second case, company pay dividend at a slow, steady growing pace. So we call constant growing dividend policy. Case number three is built on top of case number two. Company could pay dividend at the first stage, but in the end, they always follow a constant growing dividend policy. So the case number one, zero growth, is indeed a constant dividend. So this is a type of perpetuity cash flow. As we recall, preferred stock is one type of this type of cash flow. So to get the value of this type of stock, all we need to do is the dividend over the discount rate. GM issue a preferred stock at 4.25 annual dividend yield, the par value 100, and discount 5%. So how much is this preferred stock value? Okay, so P equal to D over R. Dividend is 4.25%. The par value for dividend preferred stock is 100. Discount of 5. You can get these preferred stock should trade at around $85. I give you a practice question. Notice I give you this information as well. Corporate tax rate is 35. Ask yourself, do we need this information to find out the value of this preferred stock? Now let's move on to our case number 2, which is one of the most important case in this chapter. It is look at the value for a stock paying a constant growing dividend policy. So for example here, the dividend amount are different and changing. However, as they follow a steady growing growth rate G, we are able to figure out dividend payment at a different period. If we know if company just paid a dividend at D0, then the next period dividend is grow by 1 plus G. 2 period after, grow 2 more period. And the dividend at time T is based on D0 times 1 plus G to the power of T. So how about the stock value? Stock value today, P0, depends on the next dividend, D1, not D0, not D2, D1, over R minus G. R is discount rate for this type of stock. G is dividend growth rate. In the case D1 is not given, we can simply find out using D0, grow by 1 more period. So what is D0? The one just paid, already paid out. D1 is next dividend. GM just paid a dividend $2, and you expect its dividend to grow at 3% every year after. Discount rate R is 9%. What are dividends for the next 3 years? What is the stock worth today? What is stock worth 2 years from now? So let's first figure out the dividend payment. D1 grow by from D0, grow by 1 plus G, which is 3%. So we got $2.06. D2, we grow 1 more period. You can use to the power of 2, which is 2.12. D3, we grow by another period, so we got $2.19. Okay. Now for stock price today, P0 equal to D1 over R minus G. D1 we calculated $2.12, and R is 9%, G is 3%. So this gives us price today is $34.33. The stock, what is stock value 2 years from now? So to get P2, we need the information is next dividend, which D3 over R minus G. Again, D3 is already given, is already calculated, 2.19, R is 9%, G is 3%. Similarly, we can figure out the stock price should be 36.50 cents. To summarize, once we got D0, we can predict dividend at any period. To find the stock value, all you need to do is dividend of next period and over R minus G. So this model is very, very useful. However, there's some restrictions. Of course, you can see some companies, they don't pay the dividend, or their dividend policy is not following a constant growth policy. And also sometimes companies, they are growing very fast. Their dividend growth rate is very, very quick. For example, they grow dividend at 20%. And this is a supernormal growth rate. Of course, they are not able to sustain forever because this 20% could be very likely greater than the discount rate of this type of stock. So in that case, we can't use this constant growth model. So the model, the requirement is not only dividend is grow at a constant pace, also it's the growth rate is less than discount rate R, which is we are not talking about supernormal here. I want you to now take a moment, draw the timeline, figure out the dividend for this question, figure out the stock value today and 3 years from now. So that's case 2, the most important model, dividend stock valuation model in this chapter, the one with constant dividend growth policy. Case number 3, a non-constant growth dividend. So it is modified from case number 2. You can imagine it's 2 stage, stage 1, stage 2. In the second stage, it is always constant growth. Okay? You can think about that case number 2. For the first stage, could be any kind, could be no dividend, or special scheduled dividend, or supernormal growth. So we will talk about 4 different examples. The first example, the company paid dividend $1 for 3 years, then they liquidate in year 4, get a $30 liquidating dividend. That's it. Case B, company paid the pre-scheduled dividend amount for the first 3 years, then they follow constant payment of $2 forever. C, same thing as B, but dividend follow a 5% growth. D, we will talk about supernormal growth at stage 1, 15% for the first 3 years, then constant growth 5%. To make things simple, we make a 10% discount rate assumption for all A, B, C, D 4 cases. So our goal is try to draw a timeline, indicate the cash flow and the dividend, and also work backward. So if suppose we have 2 stages, first stage is 2 years. What we're going to do is the second stage is constant growth G. So our step 1 is find out price for the second stage. So although we have a long infinity series dividend, we're going to use PT to get the value of these infinity series of a dividend. Then, based on the dividend in stage 1, we can use cash flow keys to discount, find out the present value for all these future dividend in stage 1. Okay, so let's look at the examples. For this question, so we have dividend of $1 for 3 years, liquidating $30. So this is very easy. You can use formula or cash flow keys. All you need to do is enter these cash flows into cash flow keys, then compute for net present value. Let's move on to case number B, where the dividend 3 years, we have again 2 stages. First 3 years, we have dividend $1, 1.3, 1.8. After that, the company follow a constant dividend payment and continue forever. So here, year 3 is a separation from stage 1 to stage 2. What we're going to do is first find out P3, constant growth $2, dividend R is discount 10%. So P3 is $20. So now we were going to only focus on stage 1 for the first 3 years. And we no longer care about second stage because these cash flow in second stage are equivalent to the $20 received at year 3. So what we're going to do is find the PV for these 3 cash flows. C01 is $1. Second year cash flow is 1.3. Third year cash flow is 1.8 plus 20, which is 21.8. Okay. So that's how we're going to find out the value, stock value for this case. C. Case C is similar. The only difference now, the second stage, the stock is going to grow at 5% forever. We follow the same thing. We again get the price, get the value of the stock at end of year 3 based on D4 and R minus G, where D4 is based on D3 1.8, grow 1 more period, 5%. Then discount rate is 10%. The growth rate is 5%. Okay. So once we get the P3 is 37.8. Once we get 37.8, all we need to do is now focus on first stage. We no longer need second stage because we know second stage is equal to the value of 37.8 at year 3. So we're going to get the total cash flow 1.8 plus 37.8 for the cash flow 3. So that's cash flow 2, cash flow 1. So again, we use cash flow keys and figure out the value of the stock. Now let's look at case number 4. Again, this is a 2-stage. And this is a 2-stage. Stage 1, the company follow a supernormal growth dividend policy. The dividend grow at 15%, very, very high speed. Then they go down, have a sustainable growth rate at 5%. So again, the first stage had 3 years, and starting from year 4 and after, the dividend grow at 5%. So to do this type of question, again, we want to figure out dividend payment for the first year and year 4. Then for the second stage, we get the price P3 to be equivalent of the present value of all the future dividend at stage 2. Then figure D1, D2, D3, P3, use cash flow keys, find out the stock price. So, number 1, let's figure out the dividend payment. The D0 is $1, so D1 equal to 1 times growth is 15% for the first 3 years, so 1.15. D2, we have grow by D2 we grow by 2 years, so which is 1.3225. D3 we grow by another 15%, so we got $1.5209. Now let's focus on P3. To get P3, we need the information on D4 over R minus G, where D4 based on D3 and grow by 5%. So we have 1.5209 grow by another 5%. The discount is again 10%. Growth rate for the second stage is 5%. So this gives us P3 equal to P3 equal to $31.9348. Now we can focus on first stage D1, D2, D3 plus P3. So use cash flow keys. We enter this is cash flow 01. Second year, these D3 plus P3 are the total cash flow for year 3. Okay. So basically we entered 3 cash flow, but notice for year 3, the total will be entered in the cash flow 3. So this will give us the present value of the 3 cash flow. The stock value today is 26.13. So this is called a two-stage model. Stage 1 has a very supernormal growth rate. As you see from these examples, the basic method is you want to figure out the cash flow for the dividend of the first stage, then figure out the price at the end of the first stage, then use cash flow keys to get present value of these cash flows. So case number 3, the common feature is in the end, in the second stage, it is always constant growth model. So we will work backward, figure out the price at the end of the first stage, use constant growth model. Then either the dividend at the first stage are either given or can be easily figured out. Case 3, the non-constant growth, is a bit more difficult compared to case number 2. But I still want to give it a try and deal with different examples. So we have 3 examples. The example 1, the company knows the next 3-year dividend and a final liquidating dividend at year 4. So you can simply use cash flow keys to enter those 4 cash flows. 2 and 3, you have to do the 2-stage. You have to work backward, find out the price, in this case at P2 first, then use cash flow keys. Here, it's going to, the first stage has 3 years, so you have to use golden growth model, find the P3 first. For company who does not pay dividend, or the company could be still startup company or private company, so we don't have information on the dividend information. So the alternative way to do stock valuation is use comparable variables. So you want to find out the benchmark companies, then find out the either PE ratio or price sale ratio, the comparable variable you want to pick, then use benchmark information, multiply the earning per share or sales per share of this company. How do we find out the rate of investment from buying stock? Or from the company's point of view, how do we find out the cost of raising equity? We can figure out the stock return has 2 components. One is the amount from dividend or dividend yield. The other is due to the price gain or loss. We call capital gain yield. So total return in stock investment can be decomposed into dividend yield plus capital gain yield. So that is a general case. For the special case, for the constant growth model, we can rewrite the capital gain yield is the same as the dividend growth model, dividend growth rate. So if the company grow dividend at 5%, so follow this means the price also gain at 5% rate. Let's look at some examples. So this company selling stock at 10.5. They just paid a dividend $1. Dividend expect to grow at 5%. So this is a special case for the constant growth model. We can simply find out total return from dividend yield plus dividend growth rate. So the required return is total 15% from dividend yield. Dividend of next year is $1 times 1.05. Stock price today, $10.50. The capital gain is the same as the dividend growth rate, 5%. I'm going to lastly talk about the stock quotes. So there's so many information like 52 weeks high or low range, the stock ticker symbols, dividend amount, the dividend yield, PE ratio, stock volumes, and the stock price we normally refer to is displayed in the close information. Okay, so the stock price is closed at $54.95. It is up by $1.13 from last transaction date. To summarize this chapter, we talk about stock features and stock quotes, but the main focus is how to figure out the stock value. So we went over 3 cases: the zero growth and the constant growth, case number 2, which is the foundation of the whole chapter. Then we also talk about the case number 3, the 2-stage non-constant growth, which is built on the case number 2. So that's all today for chapter 8.